On November 17, the Centre, acting on the recommendation of the Reserve Bank of India, imposed a moratorium on Lakshmi Vilas Bank for a period of 30 days. The 94-year-old bank has been struggling with losses for 3 years. The RBI has the power to ask the government to have a moratorium placed on a bank's operations for a specified period of time. Under such a moratorium, depositors will not be able to withdraw funds at will. Usually, there is a ceiling that limits the amount of money that can be withdrawn by the bank's customers. In the case of Lakshmi Vilas Bank, depositors cannot withdraw more than Rs 25,000 during the 1-month moratorium period. In most cases, the regulator allows for funds of a larger quantum to be withdrawn in case of an urgent requirement, but only after the depositor provides the required proof. Often, the moratorium is lifted even before the originally stipulated deadline is reached. Usually, the RBI steps in if it judges that a bank's net worth is fast eroding and it may reach a state where it may not be able to repay its depositors. When a bank's assets, mainly the value of loans given to borrowers, decline below the level of liabilities, mainly the deposits, it is in danger of failing to meet its obligations to depositors. A moratorium primarily helps prevent what is known as a run on a bank. It clamps down on rapid outflow of funds by wary depositors who seek to take their money out in fear of the bank's imminent collapse. It temporarily affects depositors who may have placed, for example, their retirement with the bank, or creditors who are owed funds by the bank but are struggling with the collection. A moratorium gives both the regulator and the acquirer time to first take stock of the actual financial situation at the troubled bank. It allows for a realistic estimation of assets and liabilities and for the regulator to facilitate capital infusion should it find that necessary. Singapore's DBS Bank has promised to infuse Rs 2,500 crore into the merged entity once it takes over Lakshmi Vilas Bank. A key objective of a moratorium is to protect the interests of the depositors. Even if they are temporarily handicapped by facing restricted access to their funds, there is a high probability that the bank would soon return to normal functioning once a bailout is arranged. It depends on whether the struggling bank or the regulator is able to find acquirers or investors to save the day. In the case of Yes Bank, the RBI was able to bring in investors who infused adequate funds. With Lakshmi Vilas Bank, the regulator had a ready acquirer with a sound capital base in DBS Bank, India. In the case of Punjab and Maharashtra Co-operative Bank, the moratorium is still in force over a year after it was imposed and there is still no sign of a buyer.